What if I told you that getting rich has almost nothing to do with luck? Forget the single brilliant idea, forget inheriting a fortune. What if the real gap between a life of financial stress and a life of freedom came down to just 5 simple, almost boring, long-term decisions? I know, it sounds way too simple. We're constantly hit with complexity. We're told we need to be crypto geniuses, day trading wizards, or the next big tech entrepreneur to have any chance. The internet is screaming 1,000 different get-rich-quick schemes at us, and almost every single one ends in disappointment and a much lighter wallet. Frankly, it's exhausting, and it makes the goal of building real wealth feel impossible, like it's reserved for a special club you weren't invited to. This feeling, this constant financial anxiety, is a trap. It keeps millions of people, especially those between 20 and 45, their prime building years, stuck on a treadmill. You work hard, you try to save a little, but you never feel like you're actually getting anywhere. You see your goals, like buying a house or actually enjoying retirement, just drifting further and further away. But here's the truth. The path to wealth isn't some secret maze. It's a roadmap. And today we're cutting through all that noise. We're not talking about burnout side hustles or risky bets that could wipe you out. We are breaking down the 5 core, time-tested strategies that have built real, lasting wealth for normal people time and time again. If you feel like you've been running in place, this is where you start moving forward. So let's jump into the first, and maybe the most powerful way to get rich. The first strategy is built on a force so powerful, it's been called the 8th wonder of the world: compound interest. The only thing it asks for is time. Ben Franklin put it best. Money makes money, and the money that money makes money. Here's what that actually means. Let's say you start investing $500 a month at age 25. By the time you're 65, you've put in $240,000 of your own money. But, assuming a pretty standard 7% annual return, your investment wouldn't be worth $240,000. It would be worth over $1 million. Now, what if you waited until 35 to start? To hit that same $1 million mark by 65, you can't just invest $500 a month. You'd have to invest more than double that, just because you lost 10 years of compounding. Time is your single greatest asset, especially in your 20s. So, how do you do this? It starts with investing in equities, which is just a fancy word for stocks. When you're young, you have decades to ride out the market's ups and downs, which means you can afford to be more growth-focused. Most financial experts suggest that in your 20s and 30s, your portfolio should be 90% to 100% in stocks. The easiest way to get started is with low-cost index funds that track the whole market like an S&P 500 fund. You're not trying to pick the next big stock, you're just betting on the long-term growth of the economy, and you do this inside tax-advantaged retirement accounts. If your job has a 401k with a company match, you have to contribute enough to get the full match. It's literally free money, a 100% return on your investment right off the bat. After that, open up a Roth IRA, which lets your investments grow completely tax-free. The last part of this is the most important. Put it on autopilot. Set up automatic transfers from your paycheck straight into your investment accounts every month. This makes it effortless and takes all the emotion out of it. You won't be tempted to try and time the market, which is a game almost everyone loses. You just invest, month after month, decade after decade, and let compounding do the real work for you. Okay, while going heavy on stocks is key when you're young, the second rule for building wealth that lasts is to not put all your eggs in one basket. It's called diversification, and it's basically your financial armor. Spreading your money across different types of investments helps lower your risk and opens up more ways to grow. Think about it. If your entire net worth is in the stock market, a big crash feels like the end of the world. But if you also own things that act differently, like real estate or bonds, a dip in one area can be offset by stability or even growth in another. So what does this look like in practice? Beyond stocks, the most common addition is real estate. For a lot of people, this starts with simply buying the home you live in. You start building equity for yourself instead of just paying your landlord's mortgage. As your financial situation improves, you could expand into rental properties that provide monthly cash flow. Or for a more hands-off approach, you can invest in REITs, real estate investment trusts. These are companies that own big portfolios of properties, and they let you invest in real estate without the headaches of being a landlord. Then, as you get a bit older, say heading into your late 30s and 40s, you'll want to slowly shift some of your portfolio from stocks into less jumpy assets like bonds. Bonds are basically loans you give to companies or governments in exchange for interest payments. They don't have the crazy growth potential of stocks, but they offer stability, which becomes way more important as retirement gets closer. The key with diversification is that it's not a set-it-and-forget-it deal. You have to rebalance periodically. This just means once a year or so, you take a look at your portfolio. If stocks had an amazing year and now make up too much of your pie chart, you sell a little and buy more of your other assets. This simple habit forces you to sell high and buy low, keeping your plan on track and protecting you from getting wiped out by one bad market shock. This third strategy is a mindset shift that really separates the wealthy from people who just earn a high salary. It's about moving away from trading your time for money and toward having your money work for you. This is the world of passive income. And let's be real, passive doesn't mean you do nothing. It means you put in the work once and the asset you create continues to pay you over and over again. Your day job pays the bills, but it's almost impossible to get truly wealthy from a salary alone. Wealth is built by owning things that generate income whether you're clocked in or not. Dividend stocks are a classic. You own a slice of a company, and they mail you a check as a thank you. Rental properties are another perfect example. That rent money shows up every month whether you're at your desk, on vacation, or asleep. You could create a digital product, like an ebook or an online course. You build it once, and you can sell it forever online. Other ideas include things like affiliate marketing, where you earn commissions for recommending products, or starting a YouTube channel or blog that earns ad revenue. So many millionaires say that owning a business was the key for them. It can start as a small, scalable side project that eventually creates passive or semi-passive income. When you break it down, earning an extra $100,000 a year passively isn't a fantasy, it's just math. For instance, that could be 200 people paying for a $42/month online community. Strategy number 4 sounds a bit like our first point on investing, but it has a very different focus. This is about being aggressive and strategic with where you put your money to protect it from your single biggest expense, taxes. If you ignore this, it's like trying to fill a bucket that has a giant hole in it. As you move into your peak earning years, usually your late 30s and 40s, using every single tax-advantaged account you can get your hands on is critical. You should aim to contribute the maximum amount allowed by the IRS each year. For 2025, that limit is projected to be around $23,500 for a 401k. Next up is the Roth IRA or a Roth 401k. For anyone young, the Roth is one of the most incredible wealth-building tools ever created. Think about it. If you expect to be in a higher tax bracket in the future, it's much better to pay taxes on the small seed now than on the giant tree later. Once you've completely maxed out your 401k and your IRA, you can look at a standard brokerage account. Think of it like a waterfall. Your money first flows into your 401k to get the employer match. And by the way, if this is all making sense and you're getting some value out of this, do me a quick favor and hit that like button. Section 5. Control spending and protect your wealth. This final strategy is the foundation for everything else. You can make a ton of money and be a stock market genius, but if you don't master this one thing, you'll never build lasting wealth. This strategy is all about playing defense, controlling your spending and protecting what you've built. Wealth isn't about what you earn, it's about what you keep. The number one reason most people fail to get rich is something called lifestyle inflation. As their income goes up, their spending goes up right along with it. You get a raise, you get a more expensive car, you get a bonus, you get a bigger house. Their expenses rise to meet their income, and they end up just as broke as before, but with fancier stuff. The key is to consciously live below your means. This isn't about being a cheapskate or miserable, it's about being intentional. It's about deciding your financial freedom tomorrow is more important than a new gadget today. Every dollar you don't spend on something that loses value is a dollar you can put to work building your future. But spending is only half of the defense. The other half is protecting yourself from a financial knockout punch. You need 2 shields for this, and they're non-negotiable. First, an emergency fund. This is 3 to 6 months of your essential living expenses, sitting in a boring high-yield savings account where you can get to it fast. This is not an investment, it is insurance. When life happens, a surprise medical bill, a job loss, a major car repair, You pull from this fund instead of racking up credit card debt or being forced to sell your investments at the worst possible time. An emergency fund is what turns a potential disaster into a minor inconvenience. Second is having the right insurance. This means health insurance, disability insurance, and if people depend on you, life insurance. One bad accident or illness can wipe out years of hard work in the blink of an eye. Insurance is the firewall that stands between your wealth and a catastrophe. By combining smart, intentional spending with a rock-solid safety net, you create the stable base your investments need to grow, uninterrupted, for decades. So, let's bring it all home. The 5 strategies are: first, invest early and consistently in stocks to let compound interest work its magic. Second, diversify your investments with things like real estate so you aren't wiped out by a single market crash. Third, build passive income streams so your wealth isn't tied to the hours you work. Fourth, use every tax-advantaged account you can to protect your money from taxes. And fifth, play defense by controlling your spending and protecting yourself with an emergency fund and proper insurance. None of this is a secret. None of it is flashy. But it is what actually works. Building wealth isn't a sprint. It's a marathon. It's about being consistent, disciplined, and thinking long-term. It's about making a few simple, smart choices over and over again. The road to wealth isn't about getting lucky. It's about being deliberate. The best time to start was yesterday. The second best time is right now. What's the one strategy you're going to start focusing on this week? Drop it in the comments below. And if you want to keep learning how to build a life of financial freedom, make sure you subscribe so you don't miss what's next. Thanks for watching.